Welcome back to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. He is one of the most frequent guests, one of the most frequent main guests. Michael Oliver is with us almost every week to update us on the markets, and he's for a few minutes. But Alasdair is one of the most frequent main guests because his grasp of market realities and history ring most true to me, at least. And after all, truth is what we're looking for in the show. That's what we try to find, what is really true, not what you're hearing every day necessarily in the mainstream media, but let's try to examine, use our own brains and minds, and then search out people like Alasdair who have something special to help us with. He has a background as a stockbroker, banker, economist, and he is a senior fellow at Gold Money Foundation, and he writes, at least I think almost every week, I pick something up from Alasdair at goldmoney.com. Thanks for joining me again, Alasdair.
That's my pleasure, Jay.
It's always good to have you with me, and that British accent, of course, that's welcome as well. It might not have been in 1776, but it is now. So
I won't drink tea. Don't worry.
Well, Alasdair, I get your emails, and it alerts me to the articles that you write. And again, people just go to goldmoney.com to pick that up. Can they get on the list, on the email list, so that they're sure to get your articles when they come out?
But the best way to do it, basically, the reason you get an email from me is I have a few personal friends who I send it to. But it's published every Thursday in sort of, I suppose, late morning, early afternoon on Eastern time. Yeah. And if you go to the Gold Money website and click on Research, Insights, and that is where you will find it. And I also do a market report on Friday. Which for people who have positions in precious metals might be useful as a slightly different slant, perhaps, on some of the other stuff they read.
Wow, thanks for telling me about that. I don't know if for some reason I wasn't aware of that, and I'll certainly take advantage of that. Thanks a lot for that. Well, I'd like to focus our discussion today on 3 recent articles that you posted at Gold Money, which I think our listeners should really definitely read. If they go there, they can pick them up because you do have an archive service there. So one of them is Hong Kong and the Road to Recovery. That was one of your latest ones, I think your latest one. And that was on the 20th of September. On the 14th of September, you wrote an article, "The Dollar is Central to the Next Crisis." And then we sort of named our show today after the other one, Apocalypse or Not. And that was September 6th. But I'd like to start out the Hong Kong and Road to Recovery. Its subtitle, "We Are Following the Road to Perdition." My goodness. And first of all, with regard to that article, I had to look up the word. I don't use the word partition very often, so I had to look it up. And the definition I found was it related to Christian theology, a state of eternal punishment and damnation into which a sinful and impenitent person passes after death. Eternal damnation. My goodness, that's pretty strong. I'm quite sure that you are not referring to the Christian theological concept as much as probably rather more to do with our economic well-being and facing some of the repercussions of our economic sins of the past. Is that more in line with what you had in mind? And if so, can you talk about our transgressions, our economic transgressions, our monetary transgressions, if you will, committed in the past, and what what invariably is going to take place as a result?
Yes, basically, I used the word perdition because I thought it was a pretty good parallel. You're right; it was originally in a religious reference, but we're rather like sort of Dante's Inferno. We're sort of we've printed money to the point where the amount of debt, which is the other side of the bank's balance sheet, is now so enormous we're going to get drowned in it. Drowned as opposed to burned in the fires of hell, perhaps. But you can see that every credit cycle crisis that we have gets more serious because the burden of debt every time is far larger. And if you look at the way the debt has accumulated around the world, in governments, business, and in consumers, consumer debt as well. It's increased from under 200 trillion, it's an estimate, which one of the main accounting firms produced, to around about 250, 260 trillion today. And, every government is still borrowing like crazy. I mean, the whole sort of Keynesian idea originally was that free markets got themselves into a mess, and that's why you had this, the business cycle. And government had a role rescuing free markets from their own follies by deficit spending in the early stages of a recovery. And once you got a bit of recovery, then you would pick up, the tax take would increase, and so over the cycle, you would balance your budget. That was the whole original Keynesian idea. We've gone from that completely. I mean, it's now deficits the whole way through. And there is an inflationary cost in this. It's not an even story. I mean, you don't sort of, print $1 and then sort of inflation goes up a notch. No. You've got a sort of reservoir, which I would call asset prices, if you like, an inflation reservoir.
Right.
And what happens is that you print the money, you inflate the prices of assets, financial assets. That inevitably begins to inflate the price of other assets, and property is a very good example of that. And also business assets. And so consequently, you find that inflation starts on Wall Street, as it were. It then moves into Main Street. The pace at which it moves is not necessarily even. And even worse than that, the statisticians in the government don't record inflation properly. Mm-hmm. I'm putting aside one fact, and that is that one man's inflation is not another man's inflation. You cannot actually define the general level of prices. But the statisticians that try and do this deliberately underrecord it. For why? Because there are various government expenses which are tied to the rate of inflation. And the higher that you admit inflation is, the more those expenses impact on government finances. So you can see there's a vested interest to try and keep the official rate of inflation low. The current rate of inflation in America is probably closer to 10% than 3%. And if you accept that statement, which again, I can't back it up, but I mean, you've got John Williams producing a figure like that at Shadow Stats, and you've also got the Chapwood Index, which is put together by an American fund manager, I believe, and they're saying the same thing. It's 10%, not 2%. Now, it depends where you live, it depends what you buy and all the rest of it, but the fact of the matter is it's far higher than is officially admitted. So we had a situation where, purely in monetary terms, if you look at the real rate of interest adjusted for inflation as it really is, we're on sort of, minus 5, 6, 7%. This is negative interest rates in real terms. So you've still got the stimulus going through. Now, what the answer is at the end of the day, I don't think there is an answer to it. I mean, the fact of the matter is that we've got ourselves onto a credit cycle which we can't get off because the central banks try and do the Keynesian thing of printing money to rescue the economy, encouraging banks to print money to invest in business and help the consumers spend and all the rest of it, and help the government spend as well, for goodness sake. And then, they just don't stop borrowing. And so sooner or later, this crisis is going to just get too big to handle. There was a moment during the Lehman crisis, and I think you must have felt this as well, Jay, where the whole thing was going to fall over, and we were going to have, the banks were going to be gone, the whole system would be completely destroyed. You had that horrid moment where this was a possibility. Well, just imagine with all the extra debt that's been accumulated since then, on the next credit crisis, how we're going to feel. It's going to be even worse than at the time of Lehman.
Yeah, magnitude worse. And, as David Stockman has pointed out on this show, here we are supposedly at the height of a cycle, of a business cycle, a credit cycle. And we have, completely contrary to the Keynesian idea that when times are good, the revenues would come in and the government would balance its budget, and you wouldn't have to keep piling debt on debt, one cycle after the next. But that's what we're doing. And, to me, it's pretty amazing when you think about a 1% increase right now with over 20 trillion, 21.5 trillion or something like that of debt in the United States. 1% increase, just a mere 1% increase adds to over 20 billion or $200 billion a year to the deficit. And I was looking at a chart back in the, long about early 70s. It was like, it would be 2 or 3 or 3 or 4 billion, something like that. Now it's 200 billion. So it's just exponential, it seems, isn't it? I mean, and so if you tried to work this out or if the central banks tried to be responsible and allow all this debt to be liquidated, it would be so painful. I mean, it would almost be like a world-ending event, it seems.
Well, the central banks actually have they have a mandate to stop the system collapsing. They will do whatever it takes, in Mr. Draghi's famous words, to stop that event happening, the apocalypse. But it means that if we survive the next cycle, the next credit crisis, and I believe we will, because whatever it takes will be deployed. In other words, as much money as it takes will be deployed. There may be accidents on the way, but we've got to admit that. But basically, if we have a working assumption that the central banks will rescue the system, then you have to ask yourself, what happens next? And the only conclusion I can come to is that there will be a loss of confidence in paper currencies, which means that their purchasing power will decline. And if you look at the dollar in particular, we still have enormous quantities of excess liquidity in the system, which was produced to rescue Lehman. That is still there. And the best way to visualize this is just imagine what the bank reserves at the Fed were before the Lehman crisis. I think there was about 1 or 2 months where it was in excess of 10 billion. Wow. 1 or 2 months, that was it. Now we have the thick end of 2 trillion. I mean, it's come down below that. But this is the point. All that is just extra money. Now, it's not in public circulation in the sense that it's sitting on the Fed's balance sheet. Right. But the Fed is going to produce more money on the next crisis to rescue us from that crisis. It has already got, if you like, uncleared money sitting in the system from the last crisis. So the only thing I can think is that the destruction will primarily be of the dollar this time, rather than anything else. Now, it's not going to happen overnight, obviously, but I think when people wake up to the consequences of all this expansion of money, then I think that at that stage you will find that the inflation rate doesn't go down as it did on the Lehman crisis. I mean, we had falling prices at one stage, and they had to have cash for clunkers and so on and so forth to get people to buy autos and all the rest of it. This time, I don't think we're going to see that deflationary situation. I think what we're going to see is, inflation won't come down. Inflation will probably go up somewhat, and everybody will be doing a double take and think, my goodness, what are tomorrow's prices going to be? Right. The dollar in my pocket is not going to be worth as much tomorrow as it is today. And that's a very, very dangerous state of affairs to get into.
That's when you can start the monetary velocity picking up, when people start to think, my goodness, I've got to get rid of this currency now. I better buy something that's going to keep its value. It certainly should be bullish for tangibles like gold and silver, I would think, and perhaps things that aren't as liquid as well, but tangible assets, right? So it could really start to, you have all of that money pent up in the system that is, that if it escapes and starts to be used as a purchasing power, to the extent it does, it's
But here's the interesting thing, Jay. That money doesn't need to be spent. Mm-hmm. All that has to happen is what's happened in every hyperinflation, and that is that the public realizes that they must get rid of money, if you like. Hold on, sorry.
Okay. So we're waiting for Alasdair. Hopefully we'll get him back here. he has talked about, one of the things I want to ask him about, if we get him back on here, he made the statement that Russia and China have a better understanding of the repercussions of anti-free market behavior than the so-called capitalist countries of America have. And so that was one of the things I wanted to ask him about next. He also has made the statement, really with regard to, and it sounds pretty apocalyptic that we've been talking about with Alasdair, but he's also made the statement that to retreat into the mountains and jungle hideaways to escape an apocalypse is a mistake. So, yes, I think he's probably right, because how many times a lot of us gold bugs have been warning about the end of the world, and maybe we do things that we're sorry we did. Maybe we bought too much gold and didn't buy stocks when the market turned around, or, a lot of different things. If you take a view that the world is coming to an end and it's an apocalyptic event, then you behave differently than you would otherwise.
I am back now.
Oh, good.
Can you hear me? So I'm sorry about that.
That's quite all right. That's quite all right. Alasdair, has happened to me already, and this is one of the reasons. Before I start my show, I always unplug the phone, just to make sure. But we still have some time here yet. So, right. Alasdair, I'm just sure. One of the things I want to ask you, we've talked about the credit cycle. You've talked about it before, and you felt that we're probably getting pretty close. You were talking, before we went on the air, you were talking about what the charts are suggesting in terms of U.S. interest rates. The 10-year, you suggested if we get over a little bit higher than where we are now, we could start having some real issues, you think, right?
Yes, that's right. I mean, you've only got to look at the chart, and if you plot on it the 200-day moving average and the 50-day moving average, it looks pretty awful. It looks like as soon as the yield on the 10-year goes above 3.11, and it's at 3.10 tonight, yep, then that's going to be new high ground, and it looks like there will be very little to stop it running, perhaps up to 3.5–4%. And that then becomes a very serious issue. If I can just go back to what you were saying earlier about the rise in the cost of borrowing for the U.S. government.
Right.
That threatens to turn things round. And if you bear in mind that the funders of U.S. government debt are predominantly foreign governments, you can see that they might begin to think, hold on a minute, I'm not sure that we want any more U.S. treasuries in our reserves, if they're going down. And I think they could well indeed withhold money from further investment in U.S. treasuries, which at the very least would drive yields up further.
Yes, and so we could be very close here. I mean, we've had one of the longest bull markets in equities that we've ever had. I think we maybe broke a record now, over 10 years in the U.S. anyway. Our Michael Oliver, who talks almost every week from a momentum structural analysis that he uses, his technical analysis, is convinced that we're in a new bear market for the debt instruments, and that this is going to be a big one. So what does the government and the central banks respond then? By more stimulus, as you were saying, piling more debt on top of more debt. Every cycle becomes worse in terms of the ability to finance that debt, because the debt it's not as if a dollar of debt is creating a dollar of income. It keeps getting worse, and the efficiency of new monetary stimulus becomes less and less effective. I believe you would agree with that over these cycles, right?
Yes, no, that is true. The answer basically is, that they have to stop printing money as a means of rescuing things. They've just got to let things fall over. But it's now got to such a state that the whole banking system would fall over if the Fed didn't back it. And, the knock-on effect of that on industry and everything else with a completely insolvent banking system, and we're not talking just America, we're talking globally,
right?
It's horrendous. So they're stuck in this debt trap. It's rather like, you've gone to the payday lenders and you're paying 1,000%, but you've still got to get the money. You've still got to borrow the money because you've got bills to pay and all the rest of it. What else could we do? Sort of thing. It is a debt trap. It's as simple as that, and the debt trap is springing very firmly shut.
All right, Alasdair, you scared the bejeebers out of a lot of my listeners with this talk about apocalypse. But you're mentioning in your article, apocalypse or not, it might not be. I mean, we got to put this in perspective. So with a minute and a half left here, put this in perspective. How should we behave? I mean, you were mentioning a lot of the, in one of your articles, you mentioned a lot of the gold bugs, they run for the hills. You're suggesting be a little more careful.
I mean, basically, there is in America, you've got preppers. And, as I understand it, the preppers go and buy tins of baked beans and tins of bully beef, and they retreat to a cave in the mountains and they shut themselves off the world or whatever. Now, that is not the way to behave. Obviously, protect yourself and all the rest of it, because law and order breaks down under those circumstances. We've seen that in Russia recently, for example. We see that in Venezuela now. But the only way that you get a solution to these things is to cooperate on a social basis. And so I think that if things really get as bad as they possibly could be, then I think that's one thing that we must bear in mind. I mean, we will have friends, we will have relatives, they will be in difficulty. We have to help them. We have to work with them. And we work with them on a local basis. Not on a governmental basis.
I got you. I think we're going to have to leave it go at that because we're out of time. All the things we wanted to talk about, go to goldmoney.com and read Alasdair's articles. You can read them there and pick up on the ideas that we didn't have time to get to today.